Hi guys, in today's class I want to show you how to draw the correct demand zone or supply zones, because most of you are confused how to draw basically the perfect supply or demand zone. And the truth, I want to reveal the truth first. There's no right or wrong method how you can draw your supply or demand zones. Also there's no right or wrong. There are multiple ways, and I want to show you the different ways how you can draw your zones. And it basically depends on your risk profile. There are many, basically 5 different types of zones, how you can draw them. And yeah, in today's episode, I want to show you all of them so that the confusion ends and you can basically draw your zones with confidence and yeah, bank more profits and finally become consistent profitable. So let's start with the first one. This is the traditional order block. As you can see, it's basically in the correct technical way. You can draw it from the top wick to the bottom wick, from the last counter candle before the strong impulse. Yeah, in a demand zone. In this case, you will draw it from the last sell to buy candle, or when we flip the scale in a supply case, you would draw the opposite. We don't have to complicate it. It's very basic, very simple. And the ground idea is somewhere in the near future, the price should return to this zone and then push further to the upside. In an ideal scenario, you can set basically your entry here, place your stop loss below the zone, and then target some POIs or liquidity on the upside. This video is not about stop losses or take profits. It's only about demand zones. So this is the first one. It's the traditional order block, basically the last counter candle before the strong impulse. And this is the way you draw it. You draw it from the top wick to the bottom wick. Let's move on to the next one. The next zone is the engulfed order block. So basically, you don't have to have a down candle before the up move. It could also be the same color. It could be an up candle engulfed from another impulse up candle. And the idea is that the price will return back to this level and then probably move further to the upside. And this is basically a strong impulse candle completely engulfing the previous candle. And here in this case, the color doesn't matter. It's basically the same like this, but here it doesn't have to be the opposite color. So let's move further to the next one, zone creation number 3. This is a sell to buy or pivot range. And in this case, as you can see, so in a pivot zone, there are most likely two candles before the strong impulse, and this is often a trap, or it often confuses trader, because most of the trader will place their entry right here to get a maximum risk reward ratio, but most of the time the market will only return to the pivot zone, also to the second candle, and then thrives further to the upside. So basically, if you place your entry on this level, so on the top wick from the last candle before the impulse, you will miss this move completely. And sometimes it looks pretty similar like this. So there are 2 small candles before the strong impulse, and then most of the time the price will only return to the up, also to the second candle, to the pivot zone, to the second candle, and then will move further to the upside. So yeah. Here, it would be better to place your entry here. Otherwise, you will probably miss the move, And yeah, this is the third. Let's continue to the fourth variation. This is the consolidation or range bound zone. These are most likely it's a longer range with different colors. Buy, sell, also different colors. The range bound zone, and then suddenly a strong breakout. And in this case, you are drawing your zone from the top, basically from the top to the bottom of the complete range. This is the idea, and yeah, basically in the future you are expecting that the market will return to this point, around this point. It could, of course, move further down or not, and then get the next push to the upside. And yeah, it depends on your risk profile, what where you want to place your entry, you know, because as you can see, for example, if I'm targeting this point here and then I place my stop loss below the zone, the risk to reward varies a lot, you know, depending where I place my entry. You know, if I place my entry here, then I have only a 1 to 2 roughly. And if for example, if I place my entry, further down, you know, basically in the middle of the order block, then I have already 1 to 4.4, you know. So this is the reason I mentioned in the beginning. It depends a lot what your risk to reward profile is, you know. So if you want to maximize your risk to reward, then of course you have to place your entry further down. But there is a higher chance that you will not get triggered into the trade and the market moves without you, you know. This is the downside. Yeah, and basically you have to find the middle way, you know. You have to find a middle way where you can get a positive risk to reward ratio, and you will get taken in on a lot of trades, you know. Otherwise, it makes no sense if you're always targeting basically 1 to 8, but the market never taps you in because it doesn't move. That the market could turn on this point, you know. And of course, when you make your long position, your entry on this area, then maybe you have a potential 1 to 7.5. But it doesn't make sense because the market won't tap you in, you know, as a possibly. Yeah, this is the thing what I want to teach you. The last but not least, sometimes the last candle before the strong impulse has a big long wick, you know. And in this case, more often than not, when you zoom a little further down in a lower time frame, you will see on this wick some kind of unmitigated order block, you know. And basically, this is a hidden base or a fractal zone, you know. This is a fractal zone because most of the people, they think, it's only a wick, and this is some kind of hidden zone, you know. Most of the time, the market will then in the future return to something like this, for example, and then get the next push to the upside, you know, because it's another topic, but under this candle is liquidity, and then most of the time in the lower time frame on this wick there is an unmitigated order block, which the market will return and mitigate, and then get the next drive to the upside, you know. And this is very important on the fractal zone. You have to in this case, when you, for example, when this is the M15 and you see a big wick, you know, and then a push to the upside, then I would recommend you to scale to the lower time frames. Maybe look at the M10 or M5 first, and then you see if there is any inefficiency or imbalance or fair value gap where you can refine your zone, you know. And basically, this was the class for today. If you have further questions, please let me know in the comments, or let me know what your biggest challenges are in trading, so maybe I can help you in the future. And don't forget to subscribe, hit the like button. Have a nice day, and bye-bye.